Welcome to today's interview with our special guests Eric Yeung and Ronan Manly, where we deep dive into the forces shaping the global precious metals markets. I'm your host, Claudia Merkert from BullionStar, and I'm looking forward to speaking with our guests as we break down the latest developments in the precious metals space. Today, we are joined by two of the sharpest minds in the industry. First, we have Eric Yeung, a renowned global macro strategist and expert on monetary trends with a sharp focus on how gold and silver fit into the broader financial system. Eric, thanks for taking the time to be with us today.
Thank you for having me on your show, Claudia.
We're also joined by Ronan Manly, a respected precious metals analyst from the BullionStar team, known for his deep investigative work in the global bullion market. Ronan, great to have you here.
It's good to be here, Claudia, and I'm really looking forward to our conversation. I've never seen a time more important or unprecedented to talk about these issues now.
Absolutely. Now, today we're going to go beyond the headlines to discuss the forces driving the precious metals markets, Trump's tariff threats, the shifting power dynamics in global gold reserves, and the rising tension between the paper and physical gold markets. So let's start the discussion by talking about the enormous quantities of physical gold that are being transferred from London to the US in the last 2 months. Some recent estimates are suggesting it's reached 2,000 tonnes. So just who is demanding delivery? And could this be signalling deep liquidity issues within the LBMA's unallocated gold system?
I'll start off. So, yeah, it is unprecedented that a lot of physical gold is moving to the US from London, and not just from London, from Switzerland, and it's coming in from Singapore and Australia and a lot of other places, even some of the traditional centres like Mexico and Canada, which export gold to the US. So the COMEX, well, it's happened one time before in the COVID crisis in 2020. But traditionally, the gold futures market on COMEX is a price discovery market, and it's not really known for being a physical delivery market. And the fact that it is now acting as a physical delivery market is really unprecedented. And there are a lot of bullion banks involved, obviously, and they're on both sides of the Atlantic. But the fact that there is sheer unprecedented amounts of gold flowing in to the COMEX and even other places in the US that aren't on the COMEX suggests that there is something behind the scenes that has changed, that it isn't just fear of tariffs being put on gold and silver, that people want to get in there before these tariffs might be imposed. So it's really a big structural issue that's happening. And it seems to be creating big ripples between the London market and the COMEX market. The London market was seen more as a physical market, but now, ironically, it looks like the COMEX market is acting more as a price discovery mechanism and a delivery venue. So it's very difficult to know exactly who is behind this. But the CEO of StoneX about 10 days ago came out and said that they estimated that within 7 or 8 weeks, up to maybe the 10th or 11th of February, that 2,000 tons of gold had flowed into the US. And that's way above what people were debating and talking about looking at the COMEX, where maybe like 650, 680 tons had come in. So that in itself throws a whole new spanner in the works and suggests that there are other forces that are pulling gold into the US, and COMEX is part of that.
Okay, so I agree with Ronan, and I look at it this way. If 2,000 metric tons of physical gold flowed into the US in the last 2 months, and the COMEX imported approximately 674 metric tons, that leaves 1,300 metric tons that were imported into the US by, I guess, OTC markets around the world. And all this is done within 2 months. In my opinion, if the buyer entity is not somebody with political clout, with political power, I just cannot believe that that much physical gold can be gathered and imported into the US in such a short period of time. Now, that's not the only piece of evidence that I'm looking at. I'm also looking at one more thing. Ronan just talked about the tariffs. Yes, Donald Trump announced the tariffs after he was inaugurated as president. But remember, this physical gold buying in the US, the spike, happened at the end of December. So almost a month before Trump, a month and a half almost, before Trump came into power as president. My base case on this situation is that once Trump was elected, Scott Bessent and his team looked at the financial fiscal situation of the US, the debt situation, and they have decided they got to do something. So Scott Bessent went and talked to Janet Yellen and Jerome Powell, and they proceeded to instruct US bullion banks, the ones that are able to assist them in repatriating or importing this massive amount of physical gold into the US.
Yeah, and looking at the point about who actually said 2,000 tons, this is a respectable CEO of StoneX, which is one of the biggest commodity traders in the world. And it was actually on their website, and it was in an article where the figure 2,000 tons was mentioned twice. And also, he said it on a Sky News interview, which was in Arabic, unfortunately, because we couldn't check out whether the audio was valid. But the fact that that was published on their website, and he even posted it on his LinkedIn. So it looks like they're standing over that figure. And another colleague of his called Rona O'Connell, who's the head of precious metals research for StoneX, she wrote a piece on the 10th of February where she was talking about the dislocation between New York and London and the flows coming in and out. And she said that gold is entering the US, and in brackets, in her written piece, she goes, gold is entering the US and not just into COMEX. So that's consistent with what Philip Smith, the CEO, is saying as well. Obviously, they know a lot of market intelligence. Unless they sort of slipped up by revealing that information and not realize that it would make people imply that it can't be commercial reasons and it must be a government reason. But it's all very intriguing, no matter what the real background is.
Yeah, it's very interesting. Now, in relation to that, the physical price and the paper gold price has diverged really significantly in recent weeks. So do you think we're seeing a direct intervention to suppress gold's price? And if so, who benefits from keeping the gold price artificially low?
Well, the LBMA and the Bank of England and the whole global financialized paper gold system sort of relies on their ability to continue to manage the price and not let it go out of control. And they've been doing that since the 60s with the London Gold Pool, and then they sort of let it get out of control in the 70s and reined it back in the 80s. And I wrote some pieces about the possibility that there was even a second Basel Gold Pool in late 1979, 1980, starting by the G7 central banks. But then when they introduced financialized gold, as in unallocated gold in London, which is sort of synthetic gold credit and it's fractionally backed, that system allows them to produce like unlimited quantities of paper gold. That whole system creates a lot of benefits for them. Like in a financial monetary sense, being able to control the gold price means that they can indirectly control other asset prices. But also it's very profitable for all the bullion banks to manage the price. We've seen a lot of cases of commercial banks, i.e. bullion banks, spoofing and prices and getting fined and getting criminally charged, like JP Morgan, even Deutsche Bank people. But there's been a lot of people over the years, including the Gold Antitrust Action Committee, GATA people in the States like Chris Powell and Bill Murphy and various people who, Red Chow and James Turk and a lot of people like that, who have spent thousands and thousands of hours digging into the possibility and the evidence that central banks always are in collusion with each other and with their agents, the bullion banks, to manipulate the price of gold. And that includes gold lending, for example. If there's a large amount of demand for gold and a shortage of physical available, the central banks do lend into the market to manage the price, and they've always done that. And I think that they were doing that now because you can see the gold lease rates shot up. But the fact that the lease rates shot up suggests that there was a huge amount of demand. Not so many central banks maybe want to lend anymore. So the whole system is constantly manipulating the price, like including the LBMA banks, including all the central banks and the Federal Reserve, Bank of England, Deutsche Bundesbank, and the BIS. So that's me with my conspiratorial hat on. But I've done a lot of research on that since 2011. when I started helping GATA. So I've seen a huge amount of evidence that all of that is true.
So the way I look at this, and I use this analogy and people love it, I call the LBMA basically the paper gold fire brigade. What I mean by that is they have a thin layer of physical gold and silver, as is pretty much evident at this point. And anybody who needs physical gold or physical silver, they would give it to them with that thin layer of physical gold and silver, just enough to cover the physical needs. And then when the price get out of control, I'm talking about the price of gold and silver in quotation marks, they would aim the hose, the paper physical gold and silver hose at it, and they would put that fire out. So the EFP mechanism, the short COMEX and long LBMA paper trade, that's part of that. But I just want to stop a little bit here and say that I understand why the bullion bank experts have been saying for years that they do not consider this manipulation. It's very simple, because in their minds, anybody who buy the paper promissory notes at the LBMA, they are willing paper promissory note buyers at the current market price. Okay, that's the end of it. So they do not acknowledge that there's any manipulation. All these are willing buyers. But of course, as a gold stacker, silver stacker, I look at this and I see, them watering down the physical market with, Ronan can probably tell me, 100 to 1 or 400 to 1 paper to physical, right? But I just want to explain to the audience why the bullion bank experts think that there's no manipulation. That's their logic.
Well, I mean, they may think that, but at the end of the day, this has exposed the fragility of the ETFs and the gold paper markets in everything that's been happening. And with the ETFs and COMEX contracts heavily relied upon for gold exposure, do you foresee a moment where paper gold holders realize they can't claim physical delivery? And is this system too fragile to withstand a major run on physical redemption?
I think right now, Reuters have reported that the physical delivery at the LBMA timeframe has increased from T+2, T+4 to 48 weeks, which is T+30, T+60. Now, if the physical gold market get even tighter, I can see that time elongate even longer to maybe T+90. So what should happen in that scenario, in my opinion, is that the paper promissory note, which is essentially a forward contract at this point, let's be honest, it's no longer spot gold, forward contracts. Those are going to take a huge haircut at that point. So back to what Claudia said, if that happens, then it'll be exposed to everybody to see that the LBMA paper promissory note is no longer a reflection of actual physical gold.
So, yeah, I would agree with that, Eric. And I see both the London market and the New York market as two versions of the paper market, but one is more paper than the other, if you can use that expression at the moment. The London market has been seen to be very fractional, and liquidity issues and lack of availability means that COMEX, in a relative sense, looks like it's actually functioning better as a delivery mechanism. And it hasn't yet reached a point where it might have availability of physical issues. But looking back at the London market, all of the LBMA and the Bank of England governor and one of the deputy governors all come out and say that, oh, don't worry, there's a lot of gold in the London market. Nobody is denying that. But all of that gold is owned by somebody. It's not without an owner. I previously had the view where what you do is you take the whole amount of gold that they say is in the London system, which includes the Bank of England and the commercial vaults. So everything in the Bank of England, most of it anyway, is owned by central banks. Then from that figure, you take away all the ETF holdings because they're not really available. We can argue if they're available, but they're not really available. And then what you're left with is a tiny little float, they call it, a residual. But another way to look at it is that you can say that all the gold in the London market is present, but you take away what's not available, and then you get what might be potentially available, but only a small subset of that is deliverable. And that's what we've seen now, where the clearing banks, which are like JP Morgan, HSBC, UBS, ICBC Standard, they apparently have exhausted their own stocks, which they need for liquidity in the London market. And that's why they had to go to the Bank of England to try and borrow more from central banks, and also why they short GLD shares and then redeem with those shares baskets from GLD. They use it as a sort of piggy bank. That sort of just-in-time mechanism has failed, like a car manufacturer where they can't get the parts in time. And I think a lot of their excuses about the delivery delays are just that, excuses. Because from what I can see and what I've read, I spent weeks years ago in the Bank of England archives in 2011 and 2012, and I read a lot of the old archive reports about even the vaults and the gold bar accounting system. And there was never any issues with delivery. They were delivering in 1968 thousands of tons out of the door of the Bank of England as quick as they came in. Within a few weeks period, they had 6 triple control vaults, and now they have 9 vaults. And there was never a problem back then. Back in 1940, when all the Bank of England gold had to be rushed to Canada, it was taken out in 2 months in trains down to Southampton, then up to Scotland, and then shipped across to Canada. There was never a problem. They took out 4,000 or 5,000 tons of gold in that operation. It was called Operation Fish, wartime operation. But so there's no problem getting gold out of the Bank of England. And I think that all the fact that voluntarily going in front of a Treasury Select Committee or going in front of journalists or having a LBMA webinar suggests that they're panicking behind the scenes. So going to the point about the COMEX being a paper market. So that traditionally everyone called it a paper market, but it was physically deliverable. And we can see the physical delivery happening there now. But if the dislocations continue and that the demand continues, that could also suffer an inability to provide delivery for all the longs that are requiring delivery.
Okay, Ron, and I'm looking at the latest Bullion Vault article recently that is published, and Adrian Ash have posted this chart that is basically the combined tonnage of physical gold at GLD and IAU vaults around the world. Because as we know, they have vaults in London, probably New York. So I'm looking at January 2020 to January 2021. That number went to 1,800 metric tons. So the two ETFs combined had 1,800 metric tons of physical gold. Now, you would think that with the current situation, with all this influx of physical gold to the US, you would think that the ETFs have increased their gold holdings. But no, it dropped to approximately, at this point, just right below 1,300 metric tons. So that's a humongous drop. That's 1/3 of their gold holdings gone, withdrawn by authorized participants, whom I am guessing are bullion banks. Now, my question to you, Ronan, is that where do you think, because I know, for example, GLD, back in 2020, HSBC was the sole custodian of GLD. But between back then and now, JP Morgan became sole custodian of GLD. So my question to you, Ronan, is that where do you think the gold is right now? Primarily London, or is the gold already residing in New York in the US for GLD?
On the GLD website, when you go in and you click on bar lists, they have 2 files, 2 everyday PDFs. One is showing the amount of gold bars held by the HSBC custodian. The other one is showing how many gold bars are held by the JP Morgan custodian. The HSBC one, all of that gold is in London in the HSBC vault, but in the JP Morgan one, some of it is in London and some of it is in New York. But I haven't looked in the last few weeks at that to see whether there's been major changes in that. The majority of the JP Morgan gold used to be in London, unless they've been transferring it across. But it's very interesting that JP Morgan overall became a second custodian, because why would there be a need to have a second custodian unless they wanted to gradually move the gold to a bank, JP Morgan, which is a US domiciled bank, away from HSBC, which is sort of headquartered in London, but traditionally associated with Hong Kong.
So I'm looking at also the borrowing rates of GLD shares recently. That shot up. So that's indicative of the AP's withdrawing physical gold from GLD. Now, what's interesting is that the physical gold vault levels at GLD is actually kept within range from 800 to 900 metric tons in the last couple of months. So my theory is that retail might be buying GLD. It's normal because of the current price action of gold and silver, but at the same time, the APs are withdrawing physical gold. That's why it's not moving, like the GLD gold stocks is not moving up dramatically like 2020. Do you agree with that, Ronan, with that assessment of mine?
Eric, it is very interesting that you talk about the possibility that the retail public are putting gold into GLD by buying shares, and then they have to create baskets and add gold to the trust, while at the same time the authorized participants could be borrowing shares, redeeming baskets, and taking maybe the roughly the same amount out. So on a net basis, it might look like the holdings of GLD aren't changing, but behind the scenes, there could be, as you say, a lot of gold going in and then a lot of gold being taken out by the APs. So because the GLD Spider Gold Trust is listed on the New York Stock Exchange, every quarter they have to file filings with the SEC. And so every year there's a 10K, which is the annual filing, and every quarter there's a 10Q. So the last filing was for the 3 months to the end of December, and the next one is for the 3 months to the end of March. So I've seen previously where they have to divulge, it's part of the accounting disclosure, how many baskets have been created, how many have been redeemed. So it will be interesting to see when the next 10Q comes out for the period January, February, March, which will come out middle of April probably, how many baskets have been created and how many have been redeemed. And that could help answer the question about, is the retail public putting gold into GLD while at the same time the authorized participants are extracting it?
Thank you, Ronan, for the insights, and also yourself, Eric. Was there anything you wanted to mention about that, Eric, before I move on to talking about Trump tariffs and BRICs?
We're good. Thank you.
Yeah. Well, I did have one more question actually on the subject of COMEX vaults, a slightly controversial one. Some alternative financial media suspect that gold moving to COMEX is not being freely traded, but instead being captured within the financial system, the US financial system. My question is, could this be a prelude to capital controls on gold? And is there a risk that under an emergency economic decree, the US could restrict withdrawals as they have done in the past?
I absolutely think that that is a possible scenario. As a matter of fact, I was talking to Jim Bianco from Bianco Research, and he has DC connections. And he pointed out that it's possible the US government is looking at the China model as a reference of what they're going to be doing going forward, because the China model obviously work in terms of keeping capital within China and encouraging capital investment within China. So I think what you said, Claudia, would definitely fit with that narrative if it actually happens.
Okay, thanks.
Yeah.
Thanks, Eric. What do you think, Ronan?
Well, yeah, if you think about who are the players, the participants in COMEX, it's owned by CME, which is the biggest exchange provider and trading platform in the US. And it's historically merged from the Chicago Mercantile Exchange. And it's very, very closely aligned with the government and the CFTC, the Commodities Future Trading Commission. So when you look at their website and you look at the CFTC, they're always sending letters to each other, and they're coordinating a lot. So it's strategically important, the CME. Some of those bullion banks are strategically important as well for US national security. So I would say that the CME is constantly in touch with the CFTC and with the US government and with the President's Working Group on Financial Markets, which is also called the Plunge Protection Team, which is made up of the head of the CFTC, the head of the SEC, the US Treasury Secretary, and the President, and various Wall Street heads sitting around on those forums as well. So, but if you think about all the banks that are involved, JP Morgan, Morgan Stanley, Goldman Sachs, all of these banks are part of Wall Street and part of the financial apparatus. So it's pretty easy to see that they're all talking to each other all the time. The fact that the COMEX traditionally isn't a gold delivery center, not a big one, people used to call it a backwater compared to OTC markets. London was more the center. But that has changed now. So there's some reason why a lot of gold is flowing into the COMEX. The fact that all of those big banks are involved, they're not just, I wouldn't say they're just doing it for the reasons that the media say, that they just want to take advantage of arbitrage, and there's something else going on, definitely.
Let's move on the discussion to talk about the tariffs, BRICs, and also a potential gold reset. Eric, I've got a question for you. With China stockpiling gold, could Trump's tariffs push more nations towards bypassing the US dollar in trade?
You know, that's a very interesting question, Claudia. I think countries bypassing the US dollar in trade is already happening. I mean, if somebody comes up with the narrative of saying the tariffs accelerating that, okay, maybe, right? But it has already been happening. I mean, look at China. China, I believe, still has around maybe 800 billion US dollars worth of US treasuries. But as I understand, China is no longer net buying US treasury bonds. These are long duration bonds. They might be holding a lot of T-bills, which basically, in my opinion, just US dollar cash, short duration with a yield attached to it. So to answer your question, what is China doing with its excess trade surplus in the last while? Well, China is encouraging its enterprises and state enterprises to recycle that trade surplus in its own sovereign bonds. So you see, that's why you see Chinese sovereign bonds making record low yields, because there are lots of buyers who are pushing that yield down. As a matter of fact, I believe that China, a couple months ago, I actually talked about this in detail. They launched a US dollar sovereign bond at Saudi Arabia. And that US dollar sovereign bond was oversubscribed. As well, I believe that recently the yield on that sovereign bond is actually lower than the equivalent US Treasury bond of the same time duration. So that tells you something. In terms of the tariffs, is it going to accelerate all that? Sure. But I think more importantly, we have to think about what the tariffs do to physical commodity flows around the world. I think that is the more important question that Trump is probably targeting. I think what America wants to do by erecting some of these tariffs is to basically start reshoring industries back into the US. So this is a precursor to that, in my opinion. The tariffs.
Ronan, any thoughts on that?
Yeah, I actually wrote an article back in November about Trump tariff threats, and it was just after he got elected. And I look back at Trump's negotiating style and his team in the US Trade Representative Office. So they use tariffs as threats, really, as a negotiating tool when they want to get better trade deals bilaterally with countries like Canada and Mexico and China. Trump also has a very unpredictable nature about the way he does that. So it creates a lot of uncertainty. And sometimes they actually implement the tariffs with a view that maybe the other country will back down and they'll roll back the tariffs. But sometimes it provokes the other country to retaliate with tariffs. So it all creates a lot of uncertainty, which is great for gold. But also when Trump back around the end of November as well as threatening Mexico and Canada and China, he threatened to put tariffs on all the BRICS countries, I think of 100% if they didn't use the dollar. So that, in another way, has really provoked the BRICS countries, the bloc, to move even closer to each other than they previously had been. And as Eric says, a lot of countries in that sort of sphere, non-Western countries, are doing bilateral trade deals with each other for oil, even gold for oil, and oil for renminbi, and Saudi Real for oil. So they're all starting to bypass the dollar to various extents. And I think by provoking these BRICS countries and their orbit countries like the Shanghai Cooperation Organization type countries, and even the whole global south, all of these central banks and governments are sitting up and going, what's going on here? And they were already talking about having like an international trade settlement mechanism that maybe involves commodities and gold. And at the BRICS summit in October, which was under the chairmanship of Russia, they were talking about a proposed BRICS gold exchange. So all of these tariff threats are pushing these countries to look for alternatives to the dollar and to accelerate, to some extent, de-dollarization. They won't get rid of the dollar. These countries will have to still use the dollar, but they maybe will try to minimize it to some extent.
Yeah, and leading on from that, could the US consider some form of gold backing to stabilize confidence in the dollar? And if so, what mechanisms could be used to restore gold's role in international monetary confidence?
Okay, so I'm going to take this one. I talked to Judy Shelton, and her proposal is that the US government should audit the gold in the US, and number two, revalue the physical gold that the US holds at a mark-to-market value. And then the third point that she made, which is the central piece of her new book, is to take the physical gold and issue 50-year zero coupon physical gold-backed US Treasury bonds. So the goal of that, and she talks about it, and I believe as well, is to fix the long duration US Treasury bonds. Because right now, as you all know, Janet Yellen has really shifted the issuance of US Treasuries to T-bills, to the short end. That's how the US is funding its government on an ongoing basis. That's not going to be feasible. So they want to fix the long end. And with this, 50-year zero coupon US Treasury gold bond, they can do that. Now, you might ask, well, that's great, but who are the buyers of this? Well, that's where Jim Bianco comes in, because Jim said that with his contacts at DC, he believes that the Trump administration is going to force US allies to convert a large part of the US Treasury holdings into these zero coupon century bonds. But Jim didn't talk about the gold component nor the duration. So I think what Judy is proposing would fit really well with what Jim is saying, which Jim called the Mar-a-Lago Accord, similar to the Bretton Woods.
Yeah, I'd agree that there's something definitely going on with the US Treasury and US government. The fact that they are gung-ho talking about an audit, and they're talking about revaluing the US gold reserves, and they're talking about issuing a gold-backed bond. Eric, I was going to ask you about the fact that, say, if they do have 261 million ounces, and if it was valued at, say, the current price of gold, say $3,000, I think that comes up at like 750 billion. So would issuing a gold-backed bond for maybe even that much, that's still not enough. That's still a tiny percentage of the US accumulated deficit of, say, 36 trillion. But do you think that the gold price would have to be revalued much higher to make a gold-backed bond feasible?
So that's a very good question, Ronan. I've been asked that a lot. So what is going to happen is that they are really essentially targeting the interest on debt payments. Okay, so right now, I believe that they are paying approximately almost $1 trillion in terms of interest on the debt that they owe. And they want to cut that, let's say, 25% using these gold bonds. How do they do that? It's simple. It's zero coupon. So you're forcing your allies to convert, let's say, half of the US Treasury bond holdings to these zero coupon 50-year gold bonds. And boom, all of a sudden, you cut your interest payments by 25% right there. And where does the gold component comes in? I know that a lot of people ask about using the gold to offset the debt. I don't think they are at that point yet. What they're doing is that they're using the gold as a tool to tell the allies to say, well, you're holding these zero coupon bonds for 50 years, but at least you will not get killed by inflation, because these bonds are redeemable by physical gold in 50 years. So let's say, the concept is, let's say when they issue these bonds in 2026, and the mark-to-market price of physical gold at that point, let's say is, I'm just wild guess, let's say it's $4,000 US per troy ounce. And you are, let's say, Italy, and you bought in physical gold tons equivalent, you bought 5 tons of this US Treasury gold bonds. So in 50 years, you get the 5 tons of physical gold back from the US government, but you get zero coupon, so no interest payments. And a lot of people say, why would they do that? Why would US allies agree to that? Well, the way Jim Bianco explained it is realpolitik, basically. The US government is protecting all these allies with the US military. So it's essentially a military protection fee, not only for the future, but the US is also going to claim services rendered for the last 80 years.
The fact that they're looking to do an audit, just quickly, I think it would be interesting to mention that why they need to do a full audit, because they're concentrating on Fort Knox, where there's about 56% of claimed US gold reserves of the US Treasury. But there's also 3 other locations, West Point and in upstate New York, and Denver in the US Mint in Denver, and then the New York Fed in Manhattan. So overall, there's like 44% in those 3 locations. So any audit has to be of those 4 locations, I think. And it has to be a full and thorough physical audit. And also it has to look into the ownership and the claims on the gold that they claim to have in those locations, because some of that gold could be involved in gold swaps with foreign central banks. So when Musk and Trump say we're going to go to Fort Knox and do a walkthrough with a video camera, that is great for the TV shows, but it's not really an audit. It's just it's theatrical audit. So hopefully a full audit is done and not just a partial for the cameras audit.
I do think they're going to do, probably they will have to do a full audit. If they're going to revalue physical gold, and after that, if they're going to launch these physical gold US Treasury bonds, they will have to do a full audit. But like whether or not it's going to satisfy guys like me and you, Ronan, probably not.
Well, yeah, wouldn't be in my bonnet about any gold audit. If you assume that maybe they're getting gold into the US to top up some of the gold and maybe not there, but they claimed was there. Back in 2011, a US Financial House Committee did a sort of investigation into the US gold reserves. And as part of the documentation of that, published all of our serial numbers of all the gold that's claimed to be held by the US Treasury in their 4 locations. So the fact that that's documented and set in stone could be an issue if there was some of the US Treasury gold missing and that they're flying in gold right now to top up missing gold. All of that new gold would have serial numbers from refiners and serial stamps, which are different to all of the bars listed on those documents from 2011. So personally, I'm just a bit puzzled as to how they would go about revealing that, or how auditors would go about digesting that if finds bars that are not on the gold bar list, which they previously published.
Eric, I just wanted to pick at something you were talking about earlier with regards to the gold-backed bonds. I'm wondering if you think could gold emerge as the neutral money bridge between the BRICS nations and the West? And is there a risk that the gold-backed settlement systems could challenge the dollar's role in the global reserve currency? And could you also please speak to what China is doing to assist their citizens in owning gold as well at the moment, please?
So I think gold as a neutral reserve currency is basically a given going forward. It's happening already, simply because, if you hold US treasuries, if you are a competitor to the US or a non-US ally, you're holding US treasuries, the US government can cancel your US treasury holdings with a push of a button. It is, look at Russia. look at what they are doing to Russia. So going forward, physical gold as a neutral reserve asset for the BRICS countries is pretty obvious that it's going to happen. It's already happening. If you look at the BRICS central bank's accumulation of physical gold in the last 4 years. In terms of challenging the US dollar by BRICS doing this, I think Donald Trump's administration is not necessarily trying to keep the US dollar as a international global reserve currency the way that it was before. Because the way that it worked in the past is that to maintain that, the US have to also maintain a huge deficit and print massive amounts of US dollars to keep that system going. So going forward, if the US is pivoting to reshoring, I can see that, and the evidence is already here, if the US is going to be launching physical gold bonds, US Treasury bonds, I think that the US will actually embrace physical gold as a global neutral reserve asset. Because that way, the US dollar can revert to becoming a strong regional reserve currency for itself and for its allies. And then in terms of China, what is it doing? It's actually pretty ingenious what China is doing. Traditionally, Chinese physical gold demands is from gold jewelry, as we all know. The SGE delivered approximately 1,450 tons of physical gold in 2023 and also in 2024. So around the same each year, even though the price of gold has risen almost 40% during that period. Now, recently, in January, the Chinese banks, mainly the state banks, have launched a program called the Gold Accumulate Program. And what does that do? That is essentially a paper gold savings account that any Chinese citizens can save their fiat RMB yen in. Okay, so basically you deposit money into this Gold Accumulate account, but they can convert that paper gold in that Gold Accumulate account into physical gold on a one-to-one basis with approximately a 3% premium. So that is a game changer because that physical gold that they withdraw, state bank issued, and the delivery time from my estimation from what I'm looking at from people who have done it in China is approximately 1 to 3 weeks, depending on the availability of that type of bar that you are choosing. And then on top of this Gold Accumulate program, just earlier this month, China announced that it's going to allow its insurance companies, many which are state-owned, partially state-owned, to invest 1% out of all the asset under the management into physical gold. So that's actually huge because that's a structural institutional demand for physical gold in China. Now, the BOA, which is the Bank of America, has done a research report on that. And they estimate that just with this 1% of Chinese insurance companies buying physical gold in China, and it is a pilot program, by the way, this would equal to 300 metric tons of physical gold per year, in addition to the 1,450 metric tons of physical gold that is withdrawn from the Shanghai Gold Exchange. Now, add all that to additional physical gold demand from the Gold Accumulate program that I just talked about. And I'm going to lowball. I'm going to say probably 300 metric tons of physical gold in 2025, withdrawn from the Gold Accumulate program, might end up to be 600. Because from what I'm looking at in China, on Rednote, on the social media, from the people I know, it's just insane demand of physical gold bars from that Gold Accumulate program. So let's say 300 metric tons from that. That would equate to 2,000 metric tons of physical gold just from civilian demand in China, not including PBOC demand. Now, why did I say it's ingenious in the beginning? Not because of the increased demand. I mean, like that is smart, but the ingenious part of this is the following. as the price of gold increases in both US dollars and RMB, as you probably know, Claudia, because you're in the gold industry, the discretionary spending in gold jewelry in terms of physical gold weight would go down because with the same money you buy less physical gold. So that over time might actually decrease. Okay? But as an investment vehicle through the Chinese insurance companies and also through the gold accumulate program at the Chinese banks, that gold buying is not exactly going to be price sensitive. Because as the price of gold goes up, there actually might be even more demand for investment gold in China. So I think the ingenious part of this whole thing is that China is building in structural demand of physical gold on the insurance company side and also on the banking side. So that ongoing, there's going to be structural physical gold demand increase built into the system in China.
Ronan, did you have anything you wanted to add on that particular topic?
Well, the numbers that Eric's talking about are very intriguing because, as we know, there's only maybe just over 3,000 tons of gold mined each year and maybe 2,000 tons recycled. So out of a total of, say, 5,000 tons of gold every year coming into the market, if China is taking this civilian population, 2,000 tons, and the central bank, we don't know how much, but say 500 tons, that's half of all the gold supply coming into the market, which means that all of the other participants globally have to fight for a share at the margin of physical gold. And that's why the liquidity problems that we see in the London market might become even more severe and structural problems, that everybody is now fighting for a piece of the pie. And that can only mean that the price has to go up, and whoever bids the highest will get more gold.
Well, I wanted to wrap up the roundtable today just looking at the bigger picture, if I might, and to look at whether we're looking at a looming paper versus physical gold crisis. So do you think we are witnessing an early stage bullion crisis where physical demand is exposing paper gold's vulnerabilities? Eric?
So I'm going to loop back to what Ronan posted, I guess, early last week about the whole LBMA situation. If someone is not with the intention of breaking the LBMA, why would they go through the COMEX LBMA EFP route and start this EFP doom loop? It doesn't make any sense. This is essentially airing all the LBMA dirty laundry for everyone to see. So that's my first point. And then the second point I have is, as I said earlier, if the physical gold delivery time at the LBMA increases from 8 weeks to maybe even more than that, maybe T plus 90, 3 months. What I can see happening is that the paper promissory note at the LBMA is going to take even a bigger haircut compared to the, like what Ronan said, for now, the COMEX where you can actually get physical gold. To answer your question, Claudia, is there going to be a dislocate between the paper market and the physical market? I believe so. I believe it's going to become even more severe. And eventually, everybody is going to see that the LBMA has lost its function as a global physical gold delivery marketplace.
So, yeah, I can add to that in a similar vein. From looking at the physical gold market in the 1960s, 70s, and 80s, which I did on various occasions, back then, it was really a more simple market where just you had physical demand and physical supply of gold, and they matched, and the price was derived based on that. Then when it came along with financialized gold and leverage and rehypothecation of gold and gold lending and various claims on the same amount of gold, you could see that that could never really be a long-term sustainable system because it's not honest, it's fraudulent. It's straight away fraudulent having a system of fractional reserve-backed gold. So this LBMA system was probably never intended to last a long time. and they've just been trying to keep it going for as long as possible. What we were thinking about in BullionStar, even from around 2014-15, writing articles about where is the price of gold determined? Is it by paper trading or is it physical trading? Obviously, it was paper trading. And we were thinking about what would happen in the case where there was a divergence between paper gold and physical gold. So what essentially would happen would be that the price of the paper promissory notes would go down. The gold price, in London, because the LBMA, like fixing, the LBMA gold price and what used to be called fixing is again an unallocated. It's based on an auction for unallocated gold. And it's cleared through the London Precious Metals Clearing Company, which is a private company run by JP Morgan and HSBC and UBS. So it might be a bit unintuitive to think the price of gold paper would go down, but it's going down because it's not worth anything. It only has a fractional claim, and the higher the multiple and the leverage, the smaller the fraction is. So the ultimate end game would be if there was a divergence, the price of the paper version would go to zero, and the price of the physical would kind of take off and find its own real level.
Well, there's certainly unprecedented times happening at the moment, and those of us in the gold and precious metals industries are certainly looking forward to more price transparency and some of these things being uncovered. So on that note, Eric and Ronan, thank you so much for your time today. I know our listeners will have thoroughly enjoyed hearing your insights. We look forward to having you back for another riveting discussion again in the future. And thank you also to our viewers for joining us today. I'm Claudia Merkert from BullionStar. See you next time.